Hi class, this video is the second in a line of videos on Unit 2 Accounting for Inventory, and this one is going to focus on inventory valuation methods. So there is an assumption here that you know what inventory is, you know what an inventory count or physical stock take is, and you know what a cost price is. What is the purpose of this video? I hope by the end of this video that we understand a bit more about how a small business accounts for inventory. Specifically, if we look at the success criteria, it is a successful video and a successful unit of your focus if you can describe what I mean by a perpetual inventory system, and you can explain and distinguish, so tell me what they are, tell me what's different about identified cost and FIFO, first in, first out, and we'll learn about that in a second, inventory valuation. So let's think about how we track inventory. We've learnt about a physical stock take or inventory count. We've learnt that this is really important when we do a count to work out how much inventory a business has. And we do this at the end of a financial period. But as you are learning about that, I bet you're all thinking, this sounds like a really crappy job. Why would we want to do this? And the truth is, we don't want to do this too much. It's too costly and too time consuming to do really more than once a year or at most once a month. So how does a business keep track of their inventory throughout the time when we're not doing stock takes? We never want to get into a situation where we don't have enough inventory because then we're going to lose a sale, or have too much and that might then cost us storage costs, or worst case scenario, our inventory might go off or become unpopular and then we're not going to make profit off it. We do this by adopting what we call a perpetual inventory system. What is the perpetual inventory system? An accounting system where inventory movements, inventory coming in or out of our business, are recorded continually throughout the reporting period. So every time inventory comes in or out of our business, we have a mechanism called to record it. So we should always know what every minute of every day, how much inventory of each unit we have in our business. The word perpetual means continuous, and this is why it's called the perpetual inventory system. So why use it? What are the advantages of it? Have a think, maybe even pause this video to try and come up with your list of advantages. I'm sure they're better than mine. Some of the advantages of doing this continuous monitoring is it's more efficient. We know what's happening at all times, and it gives us greater control. We can make really good decisions and hence we have control over our business. It also identifies the speed of turnover. What I mean by this is it identifies and tells me how quickly different units of inventory are moving. I know which are popular, which are not. This is important information to make decisions. Do I order more of the fast moving stuff? Do I order less of the low moving stuff? Do I need to make a sale on my slow moving stuff, or advertising, or just not stock it anymore because it's not worth it? Great information we get from the perpetual inventory system. It also, and we haven't done this, this is for a later date, later video, it also allows us to identify inventory losses and gains. So if it's great, why does not every business not do this? There are disadvantages to this. Again, pause the video, can you identify them? In summary, it is great. All businesses should do it. So why do all businesses not do this? If it's worth it, because it is timely and costly to do this. It's difficult to do this. It creates additional costs, additional record keeping, and it doesn't replace the stock take. You will learn later that we still need to do a count each month, so it's just extra work, but the advantages are worth it. How do we work out cost price? This is important for inventory, and it's really important for working out inventory coming in and out of our business. We need to record when the inventory comes in, the cost price of what it was, and when it left, what the cost price was. This is the real focus of the perpetual inventory system. And up until this point, questions just told you the cost price is this. And in reality, that isn't necessarily what happens, and source documents also won't tell you. So a business, when they're working out what's coming in and out, has a choice to make. They can either go to the effort of identifying the actual cost of each good that is left or come into our business, or make an assumption about movements of inventory. They have a choice. So in reality, the business has two methods that they can pick from for inventory valuation, and we teach both of these in VCE Accounting. Firstly, we have the identified cost method. This method identifies the actual cost of inventory when it is bought and when it's sold. So we're identifying the actual cost of each good coming in or out. This next one is one we've never heard of before, and it's called first in, first out, or FIFO. Typically, you'll just see it, the abbreviation of FIFO. This is an assumption, and this method assumes that the first goods purchased are the first goods sold. What this means is the older stock is sold first. This seems a valid assumption because this is what a business wants to happen. They want the older stock sold first. They want to keep the new stuff in stock for longer. It's not necessarily what's always going to happen, but it's an assumption, and that accountants and businesses are happy to make, and it's an accepted assumption. How do we actually identify the cost price if we're using the identified cost method? We need to do some work to actually identify the cost and put in processes to know when we sell it what the cost was. These are the ones that you learnt about typically in the first video. You could do manual coding, so put it into the price tag. So for example here, this might say that the date of the purchase was 18th of 4th, 18th of April, and the cost price was $32.50. This would be the supplier code. There could be computerized coding, so very similar to the numeric code, but when you scan the barcode, it would automatically record the cost price. Or we could just have some simple rules about markup. So if we sell something that was $25, we know that we applied 100% markup, so the cost price must have been $12.50. First in, first out is the assumption that assumes oldest inventory is the first inventory sold. So let's assume a business bought 10 units at $5 each, and then a few days later bought 10 units at $6 each. If we stop there, which is the older stock, the $5 or $6? I hope that you identified that it's the $5 that are older. They were the ones bought first. So when 2 units are sold, given we assume the oldest inventory is the first inventory sold, we assume the $5 are sold. Only once all of the 10 $5 ones have been sold will we then make the assumption that $6 ones have been sold. And this allows us to then make some assumptions and work out what has come in or out of our business. So why would a business use FIFO when it just seems more accurate to use identified cost? Firstly, it might be actually physically impossible to identify the actual units being sold. And you're going, what? Of course you can. You always know what's being sold, but there are some valid examples. Let's say a petrol station has 20,000 litres of petrol in their tanks, and it cost them $1 a litre. They then got a new delivery of 10,000 litres of fuel that cost them $1.20. Clearly the $1 petrol is older. So if we're doing identified cost, we would then have to identify which one's been left. But if for FIFO, we know the $1 is older. The issue is when a sale is made, the owner of the petrol station has no way of determining what inventory has been sold. It's all been mixed up. So they must make the assumption that the $1 petrol is used first. So only until 20,000 litres of petrol has been used can they start to think that the $1.20 petrol is being sold. And this is a good example of how it's impossible. Secondly, management might just decide it's too much work to use labels and codes and barcodes. They're just happy to use this FIFO, which just assumes first good purchased of first good sold. So now it's over to you, particularly for my class. If you're just watching us on the internet, you can still do this question. Can you work out these questions? You've got some information here. Brunswick Trail Bikes has purchased bicycle chains on many occasions in 2023. First day of each month, it buys some chains. And you can see they're going steadily increasing in cost price. And throughout the time, things have been sold. And the physical stock take on the 30th of November says there has been 30 chains. There are 30 chains left. So we add all of these up. Over the course from July, they've actually bought 100 chains, but they only have 30 left. Surely they've then sold 70. But can you work out the cost price or the value of the inventory left using FIFO and identified cost? There's information there to do it, and you'll see it creates different answers and different implications to your accounting reports. And guys, that is how we understand the perpetual inventory system and start to explore and understand identified cost and FIFO as valid, acceptable inventory valuation methods in the perpetual inventory system. We've hopefully achieved the 2 success criteria we set out to in this video, and future videos will really start to look at how we record this in and out of inventory using identified cost and FIFO using inventory cuts. So the next video will be important, but for now, keep practicing your accounting.